Hello once again, guys. Today we're going to be talking about index funds. It's a very popular topic when it comes to investing, and it is one of the first things that you guys should be considering investing in as a beginner. Now, if you guys are not familiar with index funds versus mutual funds, and you've heard the term ETFs as well, and you're just confused about all of this, then I hope to clear a lot of that up in this video. We're going to talk about what these things actually mean, and why you should start off by investing in some kind of index fund rather than picking individual stocks. So first of all, let's talk about what an index fund actually is. So an index fund is different than a mutual fund because a mutual fund is actively managed. So mutual funds have professional stock pickers that are paid that are going to allocate the money within that fund. The reason we have mutual funds is because most people out there do not have enough money to pay a professional financial advisor to manage their money. However, if people pool their money, they can collectively pay for active money management and pay to have a professional oversee their money. Now, while this was a good thing many years ago before we had index funds, it was pretty much your only option was to get involved in some kind of actively managed mutual fund. However, now we are seeing many different options as far as index funds go that are going to be significantly less expensive than these actively managed mutual funds. Now, what is interesting is the fact that most of these actively managed mutual funds where you're paying a professional stock picker to allocate those funds, they're not actually beating the average return of the market. So most mutual funds out there, those actively managed funds, are benchmarked to the S&P 500 to get an idea of whether or not they are outperforming the market. If you guys want to learn more about this, I highly recommend reading the book Unshakable by Tony Robbins, but there are also a number of articles out there talking about actively managed mutual funds and whether it is worth it to pay for active money management. But in a nutshell, the truth is most of these actively managed funds are not outpacing the S&P 500, so you're essentially paying these people money to manage your money at that point. You're paying them to manage this fund, and they're not even able to outperform the market. So the big question people have is, what are you actually paying for if they're not able to outperform the market, if they're just basically underperforming what you could get from an index fund? Now, an index fund is different than a mutual fund because it is not actively managed. With an index fund, it is tracking an underlying stock market index. For example, let's say we have the S&P 500 or the Dow Jones Industrial Average. You could also have one tracking the NASDAQ or New York Stock Exchange, for example. So basically, this fund is built to replicate the performance as closely as possible to an underlying stock market index. As a result, you are not paying a professional stock picker to allocate that fund or move things around, and that results in a much lower expense ratio. So not only are you spending less money on fees, you are also replicating the performance of the overall stock market. And as we have seen historically, owning the market as a whole is one of the best strategies because most people are not able to outpace the market or get a return that exceeds the market. Even these professional stock pickers that manage these mutual funds oftentimes are unsuccessful when it comes to beating the market average return. So in my opinion, and many people agree with me, the best strategy is to own the entire market as a whole rather than trying to beat the market. Now, as I'm sure you guys know, I do own individual stocks, and I do recommend doing this if you guys want to be a more active investor and you want a more active role in your investments. But I do think the first place you should start as an investor, if you're a complete beginner, is to start investing in Vanguard index funds. And one of the best ways you can do this is through an ETF. Now, an ETF is known as an exchange-traded fund. It allows you to invest in these Vanguard mutual funds. Now, they are called mutual funds, but understand it's a mutual index fund, meaning that it's a mutual fund, but it basically tracks an underlying index. So as a result, you're not paying these crazy expense ratios you would see with some other mutual funds out there. But ETFs allow you to invest in these mutual funds that Vanguard offers through individual shares. So the one disadvantage to some of these index funds or mutual funds is the fact that there is a high barrier to entry. Many of these funds have a $3,000 plus minimum account balance, or even more if you're looking for the Admiral shares. Now, Admiral shares, just to cover that, what that is, it is accounts reserved for larger investors. So if you have, I think the minimum is $10,000, it might be higher, but if you have $10,000 or more, depending on the fund that they offer, you can invest in Admiral shares, which allows you to have a larger expense ratio due to the fact that you're investing a sizable amount of money. So if you are someone who is a complete beginner and you don't have $10,000 or even $3,000 to invest in a fund through Vanguard, you can still invest by investing through an ETF or exchange traded fund. It allows you to invest in these funds for the price of a single share. Now, the share price for these funds is different for each one, so you're going to want to do your own research, but this allows investors to get in a lot earlier than they would if they had to save up $3,000 or more to invest through the Vanguard website. So if you're a complete beginner and you have less than $1,000 to invest, the place that I would recommend you start is with ETFs offered through Vanguard. And we're going to go through the website here and I'm going to give you guys some recommendations as far as what are the best funds to get started with as a complete beginner. Now, why do I recommend beginners start off with index funds? The reason I do this is because you are well diversified that way and you own the entire market at that point. So the reason you do this is because you're going to see less volatility owning the entire market than you will owning individual stocks. Owning stocks is riskier than owning the entire market or owning index funds, but as a result, a higher risk often yields a higher return. Now, the problem with that is many people who are new to investing have no risk tolerance. They have never lost money or been down on an investment, and as a result, they are prone to making emotional decisions. Now, there's a lot that goes into this. There's a lot of psychological reasons why people make these decisions, and that is going to be a topic for another video. I've done topics on this or videos on this in the past, but understand that as a beginner, you are prone to make emotional decisions when it comes to your investments. So your best strategy is to start off with a lower risk investment, get your feet wet, experience some volatility, experience a little bit of loss, and start to get comfortable with seeing price fluctuations. Once you are comfortable with that, that is when I recommend easing into blue chip stocks. These are the stocks of large, well-established, and financially stable companies. But before we do that, it's important to get some baseline experience investing in these index funds. And the best way to do that for beginners is these ETFs, because you don't have to have thousands of dollars to get started. In fact, if you guys do this through Robinhood, you can start an account for pretty much nothing. It's a $0 minimum account balance with $0 trading fees, so you don't pay commission on your trades. So I recommend beginners get started on Robinhood if you're in the United States. Open up a Robinhood account. I have a link in the description. So open up a Robinhood account and invest through these ETFs in some kind of Vanguard mutual index fund that we mentioned in this video here. So first of all, it is worth mentioning that there are a number of different financial institutions you can go through as far as index funds go. So why would you choose Vanguard? We're right here on the Vanguard website, so I'm just going to go ahead and let this site do the talking for us. The average Vanguard no-load mutual fund, and no-load means that you're not paying any money on the way in. A lot of these mutual funds require you to pay a certain percentage of what you invest at the get-go. That way you are paying into that mutual fund. So that's also called that's like a front-load mutual fund where you have to pay money just to put funds into that mutual fund at that point. So Vanguard has a no-load mutual fund, meaning that you do not have to pay to start investing in this fund. So the average Vanguard no-load mutual fund expense ratio is 83% less than the industry average. So these funds are significantly less expensive than what you pay for other mutual funds out there. Now, I know that doesn't sound like a lot to you guys, but if you want to see the true effects of this, take the expense ratio of some mutual fund that's actively managed out there versus a Vanguard expense ratio and look at that difference compounded over 25 years, and then you will see the difference in the price there as far as what you're paying in that expense ratio. So just understand that while it doesn't sound like a lot of money, over many years compounded over time, it does end up being a significant amount of money. So you want to make sure that you're investing in the best way possible and spending as little money as you can on that expense ratio. Otherwise, you're going to be losing money every single year that could be earning you compound interest over decades. Now, the idea with index funds, guys, it's not to make money overnight. It's not to make money in 1 week or 1 year. The idea with index funds is to earn money over time and to allow yourself to earn compound interest over many decades. So don't think that you guys are going to invest in an index fund and end up making 1,000% on your money next week. You're going to be making consistent 8 to 10% returns historically over the last 100 years. That is what the stock market has paid out on average. So your goal is to earn about 8 to 10% per year over many decades. Now again, that may not sound like a lot of money to you guys, but if you've never played around with a compound interest calculator, go ahead and try that out. Put that figure in there of whatever your initial investment might be with your regular contributions, and then add 8 to 10% as your return and see what that comes out to be in the end. And you'll be surprised how much 8 to 10% per year can really do for you over a long period of time. So let's go ahead and talk more about these index mutual funds that Vanguard has to offer, and this should explain why these are what I recommend to pretty much everyone out there when it comes to owning a broad piece of the market. So first of all, what are index mutual funds? I'm just going to go ahead and read this off to you guys because this is right off the Vanguard website and they say it best themselves. Instead of hiring fund managers to actively select which stocks or bonds the fund will hold, an index fund buys all of the securities in a specific index like the S&P 500 index. The goal of an index fund is to track the performance of a specific market benchmark as closely as possible. That is why you may hear it referred to as a passively managed fund. So mutual funds are traditionally actively managed funds because we are paying that professional stock picker to make decisions on our behalf. While with an index mutual fund like the ones Vanguard offers, we're not paying that professional stock picker, we are just replicating the performance of a market benchmark like the S&P 500 or the Dow Jones Industrial Average, and as a result it is going to be significantly less expensive than paying for active money management. So here are some of the benefits of investing in index funds. First of all, there are lower costs because index funds hold investments until the index itself changes. They generally have a lower management and transaction cost. So when you have people or fund managers allocating funds differently, buying things and selling things, you're going to be paying transaction costs every single time, and that's going to rack up those commission costs as far as what's involved with that mutual fund. Also, there's lower risk through broader diversification. So these index funds are going to give you exposure to broad markets rather than investing in a select pool or one select security. And they're also more efficient with taxes because broad index funds generally don't trade as much as actively managed funds might. So they're typically generating less taxable income, which reduces the drag on your investments. Now, if you guys are not aware of this, we do have long-term and short-term capital gains tax rates here in the United States. So anytime a mutual fund buys a particular investment and sells it within 1 year, it's going to fall under the short-term capital gains tax rate, while if you hold something for longer than 1 year, it's going to be a long-term capital gains tax rate. And the difference between those things can be as much as 20% depending on what tax bracket you fall into. And I've done videos about this on my channel if you guys want to see the difference between long-term and short-term capital gains tax rates. So we're going to go over a couple of the options that you guys have through Vanguard. When you visit the page here, you have the option to look at mutual funds, those mutual index funds, or the ETFs. I'm guessing most people are interested in these ETFs because, as we said, there are significantly lower barriers to entry because you can buy literally one share of these through a stockbroker, through Robinhood or whatever your stockbroker is. So it's much less expensive to get involved with these ETFs. So first of all, we have these bond ETFs, which are going to give you broad diversification to different bond funds out there. We have corporate bonds, we have municipal bonds, and then we have government bonds. Now, government bonds are considered to be the safest, the lowest risk out there, so they don't actually get rated by any credit rating agency because they're considered to be the safest investment out there as far as bonds go. Any other bonds out there, municipal bonds and corporate bonds, are going to have a bond rating from either the S&P or Moody's rating agency. So we have a number of different government bonds offered. First here we have a extended duration treasury ETF, an intermediate term bond ETF, an intermediate term treasury ETF, a long-term bond ETF, a long-term treasury ETF, and it goes on and on and on there. I'm not going to go into much detail about the bonds here, guys, but I do want you to know that the longer the term is, the higher risk that bond is considered, and it's going to command a higher rate of return. So if you want to have a better rate of return from your bond fund, you're going to want to invest in a longer duration term. And if you guys are looking to have the lowest risk as possible, I would go for these government bond ETFs. But to be honest with you guys, the fund that I recommend for most people is the long-term bond ETF BLV. And so let's go ahead and look at these numbers here. So first of all, the expense ratio is 0.07%, very low. The price per share is $94.48, so you can get one share of this bond ETF for under $100. This fund has returned 9.68% year to date, 9.8% over the last year, 3.87% over the last 5 years, and 6.94% over the last 10 years. And since inception in 2007, this fund has returned 7.17%. So if we click on this fund here, it gives us a little bit more information about this fund. It says that it seeks to track the performance of the Bloomberg Barclays US Long Government/Credit Float Adjusted Index. It is exchange-traded shares class, passively managed using index sampling, diversified exposure to the long-term investment grade US bond market. So first of all, what does investment grade mean? That means that it is a bond worthy of a long-term investment. You have two categories when it comes to bond. You have investment grade bonds and junk bonds. It has to do with the credit rating from Moody's or Standard & Poor's. So as an investor, you always want to invest in investment grade bonds. Junk bonds are going to have a higher rate of return, but they are also significantly riskier because the credit worthiness of that borrower is lower. So I always recommend investing solely in these investment grade bonds. And I like this fund because it gives you broad exposure to long-term investment grade US bonds, and it provides high current income with high credit quality. That is why this is the bond fund I recommend to most people. It gives you a comfortable amount of risk, and as a result, a decent rate of return over the last 10 years. Now, if you wanted to be even more diversified in the bond market, there is also the Total Bond Market ETF. The symbol is BND, and we're going to go ahead and go over the performance of this over the last number of years. So this one has a lower expense ratio at 0.05%. Currently, it is $81.55 per share. And year to date, it's returned 3.27%. Over the last 1 year, 3.36%. Over the last 5 years, 1.89%. And over the last 10 years, 3.88%. And since inception in 2007, 4.17%. So this bond fund is going to give you more exposure to short-term, mid-term, and long-term bonds. But as a result, it's going to return a lower rate due to the fact that you have broader diversity, and you're going to have less risk involved with that. But I think most people would be comfortable with a little bit more risk, and that would yield a better return in the long run. And then these funds here are all going to be corporate bonds that are investment grade. You have a long-term, intermediate term, short-term, and then a total corporate bond ETF here available to you. These are also great options if you want to be involved in corporate lending. Essentially, this is money that is being lent to corporations, and they are paying back a fixed rate of return, and it's going to give you broad exposure to many different corporate bonds out there. And then one other bond fund worth mentioning is this tax-exempt bond here, because most municipal bonds are exempt on a state level and they are all tax-exempt on a federal tax level. So now we get into these stock ETFs out there. And guys, there are a lot of different options. We're not going to talk about most of these, but I want to point you guys to some of those that I recommend to the complete beginners. I think the best fund for beginners out there is VOO, that is the S&P 500 ETF. Now, some people would argue that that's going to be higher risk than some of the other funds out there available, but I think most young people would be able to be comfortable with that level of risk, and essentially this fund is going to replicate the performance of the S&P 500. The symbol is VOO. The expense ratio is at 0.04%. Currently, it's $245.03 per share. Now, the performance of this fund is pretty incredible over this last year. So year to date, it's up 21.15%. Over the last year, it's up 22.8%. And over the last 5 years, it's at 15.72%. And this fund was created in 2010, so since its inception, it's had a 15.42% return. Another great option is the VTI Total Stock Market ETF, same exact expense ratio, and over the last number of years, the performance is actually quite similar. So first, let's talk about this Vanguard S&P 500 ETF, VOO. It says it invests in stocks in the S&P 500 index representing the 500 largest U.S. companies. The goal is to closely track the index's return, which is considered a gauge of overall U.S. stock returns, offers high potential for investment growth, share value rises, and falls more sharply than that of funds holding bonds, so it is a little bit higher risk. And it says it's more appropriate for long-term goals. I would say that pretty much for any type of ETF or index fund investment. Now, the VTI fund is going to give you exposure to the entire U.S. stock market. It seeks to track the performance of the CRSP U.S. Total Stock Market Index. It gives you large, mid, and small cap equity diversified across growth and value styles. The fund remains fully invested, and it does have a very low expense ratio. So if you want to have more diversification than the VOO fund, you could go for the VTI. It's another great option out there for passive investors. Now, it's also important to consider investing in markets outside of the US because the total US stock market capitalization is about 35% of the total global market capitalization. So if you invest all of your money into US stocks, you have 100% of your money invested in 35% of the total market. So it's great to have exposure to other international markets, and one of the best ways to do that is through international ETFs that Vanguard offers. So the best fund for this, in my opinion, is the Vanguard FTSE All World, and I think people call it the FTSE. I'm not sure if that's the case. I know somebody corrected me on that last time, but it's the Vanguard All World Exempt US ETF. So this seeks to track the performance of the FTSE or the FTSE All World Exempt US Index. It provides a convenient way to get broad exposure across developed and emerging non-US equity markets around the world. So this is going to allow you to invest solely in markets outside of the US. So a great strategy would be to pick a good US index fund, maybe VOO or VTI, and then also invest some of your money in one of these funds here like VEU to give you exposure to non-US markets as well. And then the most diversified fund out there is the Vanguard Total World Stock ETF VT. It invests in both foreign and US stocks. It seeks to track the performance of the FTSE Global All Cap Index, which covers both well-established and still developing markets. It's going to give you exposure to both US and non-US markets. You essentially own the entire world stock market at this point through this fund. So those are the main funds that I recommend to beginners, and I just want to show you guys a couple of the other funds that Vanguard has to offer. So once you are well diversified in some broad index funds, you may consider picking up some specialty or sector ETFs that are going to give you specific exposure to certain sectors. And I want to show you guys which ones Vanguard has to offer. They have a consumer discretionary ETF, they have a consumer staples ETF, an energy ETF, a financials ETF, a healthcare, industrials, information technology, materials. They have a real estate investment trust ETF, which is going to give you exposure to REITs, which is essentially a way to invest in real estate through the stock market. They have a telecom services ETF, and then a utilities ETF. So if you wanted specific exposure to a certain sector, you could also do that through Vanguard. But yeah, guys, that pretty much wraps this up. This is a good overview of the funds that Vanguard has to offer, as well as why you should consider investing in index funds. And so I think that index funds are a great stepping stone to entering the market. You start off with some broad index funds that basically becomes the bedrock or foundation of your portfolio, and then you may decide to pick up some more niche specific or sector specific ETFs, and maybe then you'll venture into some individual stock ownership through blue chip stocks and eventually onto some growth stocks. Now, if you guys are looking to learn more about investing in the stock market, I do have my Stock Market Mastery course. It is a 12-hour course teaching you guys everything I've learned over the past number of years about investing as far as my investing strategy goes. Now, the course is currently closed due to a high volume of students. I spend a lot of time with people one-on-one helping them learn how to invest. So as a result, I don't bring in a ton of people at once. But if you guys do want to get on the waiting list for this course, the link for that is in the description below. And I think it would be a very valuable learning experience for you as far as learning how to invest in the stock market as a beginner. Yeah, that's all I got for this video. I thought this would be an interesting overview of these funds available. If you guys enjoyed this video, please drop a like. If you're new to my channel, please consider subscribing to be notified of any future uploads. And as always, I thank you for taking the time to watch this video.